In the 2026 economic environment, traditional 60/40 portfolios and tech-heavy indices like the S&P 500 are under significant pressure. With the Federal Reserve holding interest rates steady at nearly 4% and cost-push inflation remaining high, these conditions simultaneously lower bond prices and compress the valuations of mega-cap technology stocks. Navigating this landscape requires a move away from standard market cap weighting. Instead, we are constructing a resilient portfolio architecture using 4 specific, functional ETF building blocks. The first 2 blocks manage defense. VBIL acts as a safety shield. It holds zero-duration Treasury bills to capture high cash yields without exposing the capital to interest rate risk. Next to it is SCHD, our valuation buffer. This holds high-quality, dividend-paying equities that generate current cash flow, helping protect purchasing power against inflation. The final 2 blocks provide the offensive component. VT is the growth engine. It offers broad global equity exposure to capture worldwide growth while diluting the concentration risk found in the U.S. market. Finally, XLE serves as an inflation shield. This is a targeted energy sector allocation that acts as a hedge against supply shocks and rising commodity prices. By separating your investments into these 4 distinct mechanical roles, safety, value, growth, and hedging, you can calibrate your defense against stagflation based on your specific risk tolerance. We can apply these blocks starting with the conservative allocation, where the priority is strict wealth and capital preservation. In this model, half the portfolio is anchored in cash equivalents, with a 50% allocation to VBIL. From there, 35% goes into dividend-paying value stocks through SCHE, and the remaining 15% provides global stock exposure through VT. Note that the energy hedge, XLE, is left at 0%.
Capital preservation relies on securing high cash yields rather than introducing the sector-specific volatility associated with energy stocks. For investors with longer time horizons, the moderate allocation balances capital protection with long-term growth. In this model, the cash yield drops to 20%. That capital is redeployed to expand global stocks to 40% and introduce our inflation hedge, XLE, at 15%. The dividend buffer, SCHD, is adjusted to 25%. This shift funds a targeted inflation hedge and broader market participation by actively reducing the safety margin provided by our short-term cash position. Moving up the risk curve in a stagflationary environment requires a mathematical trade-off, decreasing absolute cash safety in exchange for targeted geopolitical and inflation defenses. The aggressive growth portfolio focuses on maximum capital appreciation and inflation hedging.
If our cash allocation, VBIL, drops to 0%, how would you distribute the remaining 3 blocks? Pause the video and calculate your percentages. For an aggressive posture, the allocation is 50% to global stocks with VT, 30% to dividend equities and SCHD, and 20% to the XLE energy hedge. Global stocks reach half the total portfolio weight because VT serves as the primary engine to capture long-term worldwide growth without the performance drag of a cash position. To balance this growth, we increase the inflation hedge to 20% through XLE, while keeping the portfolio anchored with a 30% allocation to high-quality domestic cash flows via SCHD. An aggressive posture in 2026 replaces the safety of a cash buffer with targeted equity positions chosen to counteract rising consumer prices. Mapping all 3 models side by side in this allocation matrix reveals a seesaw effect that connects them across the risk spectrum. We see an inverse relationship between cash and global growth. As risk tolerance increases, the reliance on short-term cash drops from 50% down to 0, while the global growth engine scales up from 15% to 50%. The tactical hedge also follows a clear pattern. XLE enters the portfolio only as cash safety is removed, increasing progressively to counter the specific threat of inflation. You can use this matrix as an adaptable blueprint for navigating high-rate, inflationary markets. Stability during economic turbulence comes from systematically balancing these 4 pillars to align your personal risk with the macroeconomic reality.